Welcome to the deep dive. This is where we take a huge pile of research, articles, data, all that complex stuff, and we try to boil it down to the key takeaways, the things you really need to know. Today, we're diving into a real head scratcher. The Bahamas, we've got this really in-depth market analysis right here. And on the surface, it looks amazing. High GDP per capita, fantastic internet, tax neutral. You'd think perfect for iGaming, right?
Yeah, I really would.
But the final verdict from our sources, after looking at the Gaming Act of 2014 and how things actually work there, it's a clear avoid for most operators.
Yeah.
So our mission today is to unpack this really unusual, kind of bizarre dual market system and figure out why a place with so much going for it is actually, well, pretty hostile to new iGaming investment. But first, maybe tell us a bit about the source. Who put this analysis together?
Right, so we're the Gambling Databases research team. Basically, we're a group focused on delivering these deep analyses of the global iGaming landscape. In every report, like this one on the Bahamas, we look into, the local rules, the taxes, what it's like for players, for operators, and emerging trends too. Our whole goal is to give you a really clear, data-driven picture of how gambling works in each specific market and what makes it, well, unique. At the Bahamas, it's definitely unique.
Yeah, unique feels like an understatement here. I mean, look at the stats. Population over 400,000, stable GDP per capita is what, $33,968? That's the second highest in the English-speaking Caribbean.
It is. Very strong numbers.
And internet penetration is 94.8%. So you've got an affluent population that's already online, mostly mobile. It seems tailor-made.
It absolutely looks like a golden opportunity on paper. But then came the Gaming Act of 2014, and that piece of legislation just, well, it changed everything. It set up the structure we need to understand today.
Right. So let's get straight into that. The regulatory shock, this tale of two markets thing.
Exactly. That's the core of it. A dual market system, completely separate. So on one side, you have these big land-based casinos. Think Atlantis, Bahamas. But they are strictly for foreign tourists and non-residents only. We're talking like 8 million visitors a year, mostly American. That's their target.
Okay, tourists only for the big casinos. What's the other side?
The other side is the domestic online gaming market. This runs through just 7 licensed companies. They're locally known as web shops, and they serve only the local Bahamian residents.
Okay, and here it comes, the really critical piece, the part that just seems unbelievable. Bahamian citizens, permanent resident, even people there on work permits, and their spouses. They are specifically banned by law from gambling in those casinos. Is that right?
That's absolutely right. It's written into the law. The entire local population, all 403,000 of them, are legally prohibited from casino gaming.
So you've got these massive world-class resorts literally on their doorstep, generating huge amounts of money for the country.
Right.
And the people who actually live there are told, nope, not for you.
It's a discriminatory restriction. A legal wall, basically, separating the local population from the international casino floors.
How does that even work in practice? And how do operators possibly build a business model around that?
Well, for the casino operators, they just don't factor in the locals at all. Their model is 100% dependent on foreign tourism, which, as we'll see, is pretty risky. But yeah, it definitely creates tension. We know the Gaming Board Chairman, Dr. Daniel Johnson, has actually argued publicly to change this. He sees it's unfair, probably inefficient too. But those proposed changes, they're still pending, stuck somewhere in the legislative process.
Pending, that sounds
He's stuck in uncertainty.
What does pending mean if you're thinking about investing millions?
It means regulatory uncertainty with capital letters. For finance people, that means you have to use much higher discount rates when you model potential returns. Because if a law change might totally change your market access, but you have no idea if or when, you just wait. You don't commit capital.
So no one's launching a new online operation based on a maybe change.
Definitely not. Meanwhile, this delay actually helps the existing web shops, right? It keeps their local monopoly intact.
It sounds like the whole system was set up perfectly to protect the big resorts and those local web shops.
It certainly looks that way. That domestic market is neatly divided among those 7 licensed web shops, like Island Luck, Chances Games. They offer locals lotto, slots, sports betting, all online.
And it's not a small operation, these web shops.
No, not at all. The research shows they employ around 2,800 licensed staff. That tells you there's a real established gambling culture among residents, a culture you can only tap into if you're one of those 7 licensed web shops.
Okay, but there's another barrier, isn't there? Something that stops the usual iGaming expansion plan.
Right, using the Bahamas as like an offshore licensing hub.
Yeah.
That's also explicitly prohibited. You cannot manage online gaming websites from within the Bahamas that target international players. So that kills the main business model for most pure iGaming companies who want to use a license in one place to serve customers globally. The Bahamas says no to that.
Okay. Wow. So the regulations are restrictive, discriminatory even. Very tough. Let's switch to the money side. The Bahamas is known as a tax haven, a big financial center. Does the tax situation make up for all this regulatory pain?
That's the million-dollar question, isn't it?
Mm.
And yeah, the tax setup looks incredibly attractive at first glance. It's a totally tax-neutral environment. Zero corporate income tax. Zero personal income tax. For operators, for players, nothing.
Zero corporate tax. That sounds amazing. So what about the specific tax for the web shops, since that's the only online play?
Okay, so the gaming house operators, the web shops, they pay an 11% tax on gross gaming revenue, or GGR. And GGR is defined pretty simply. It's the money wagered minus the winnings paid out, just 11%.
11% is really low compared to
Right.
most places. Europe, the U.S. rates can be 30%, 40%, even higher.
Exactly. 11% is very favorable. And for players, their winnings aren't taxed either. It's a tax-free experience for them, which definitely encourages play.
All right, so 11% GGR tax, zero corporate tax, zero player tax. That should mean high profits. So where's the catch? Why isn't it incredibly profitable?
The catch is simply the cost of doing business there. It's what the report calls high island operating costs. These costs just eat away dramatically at those tax advantages. You're paying premium rates for everything, salaries, utilities, and especially rent.
How high are we talking for rent? Give us a sense of scale.
Well, for commercial office space in Nassau, you could be looking at 25 to 40 US dollars per square foot per year. That's pretty steep.
Okay, that's significant.
And then you add the staffing costs, not just salaries. Every single employee, down to the cashiers, needs an individual license from the gaming board. The admin burden, the compliance cost, it just skyrockets.
So that low 11% GGR tax looks good in isolation.
Exactly. But once you factor in the really high fixed overhead, the rent, the utilities, the cost of managing hundreds of licensed, well-paid staff, the actual operational burden can end up being effectively just as high as somewhere with a much higher GGR tax, but cheaper labor and rent. The tax advantage kind of evaporates.
So you're paying through the nose for operations, which cancels out the tax benefit, and you're still stuck in that restrictive market.
Pretty much, yeah. The tax benefit gets neutralized by mandatory high costs.
And if someone was thinking, okay, forget web shops, I'll go for the casino model.
That door's basically shut, too. Casino licenses aren't just for gambling. They require these huge, multi-hundred-million-dollar investments in integrated resorts, hotels, restaurants, entertainment, the whole package.
Like Atlantis or Bahamas?
Precisely. And there are only 7 of those licenses in total for the whole country. 6 are already taken by huge international resort companies.
So it's not really an option for a pure iGaming company looking to grow. It's for giant hospitality players.
Correct. Not an entry point for your typical iGaming operator.
Which brings us, finally, to the verdict. Why gambling databases gives this market, despite the GDP, the internet, the nice tax rates, only a 3.9 out of 10 overall market rating, that avoid rating. It must come down to some really fundamental deal breakers beyond just high rent. What are the big risks?
There are 3 critical ones, really structural issues. First is just micro-market economics. That population, 403,000 people. It's just too small for a competitive market. And the domestic web shop market, the only one accessible for pure online play, is already saturated. You've got 7 established players already there.
7 companies fighting over fewer than 500,000 people. Sounds tough.
It's more than tough. The analysis literally says scaling for a new entrant is mathematically impossible. You end up spending crazy amounts just trying to acquire customers.
Which leads right into the second risk, doesn't it? That discriminatory dual market system.
Exactly. By locking out all the locals, the big casinos are 100% reliant on foreign tourists. And 85% of those tourists are American. So if there's a downturn in the U.S. or travel patterns change, boom, the casino revenue tanks. There's no local buffer.
And the web shops?
The web shops have a local buffer. Their revenue is domestic, probably more stable. But again, it's tiny and saturated. There's no real growth potential there.
Okay, and the third risk, the one that stops the offshore idea.
That's the clear prohibition on international iGaming. You just cannot use the Bahamas as a base to serve global customers. It eliminates the main expansion strategy for most online gambling platforms. You have to operate locally within that impossible micro market. That's it.
Let's zero in on those impossible economics in the local web shop market for a second. Customer acquisition costs. You mentioned they were high.
Cripplingly high. Because there are basically no new customers to find, the 7 existing operators are just trying to steal customers from each other. The report estimates customer acquisition costs, CAC, are between $500 and over $1,000 per customer.
Wait, up to $1,000 to get one customer in a market of 400,000 people. As an operator, I'm thinking the lifetime value, the LTV of that customer would have to be absolutely enormous just to break even on the acquisition, never mind profit after tax and overhead.
You've nailed it. The required LTV is astronomical. The analysis figures that a new entrant probably wouldn't break even for 3 to 5 years, maybe longer. You're fighting established brands with existing loyalty. Aggressive marketing just isn't viable.
So wrapping it up, the Bahamas. It's a sophisticated financial place, sure, but the gambling regulations create these massive roadblocks. They're deal breakers for a typical iGaming business.
Absolutely. The market really only works for 2 types of players. The giant mega resort developers who see gambling as just one part of a huge hospitality investment, or the 7 existing local web shops who are quite happy with their protected little monopoly. For any other online operator, anyone focused on growth or global reach, the combination of the rules, the saturation, the costs, it just screams avoid.
So that's our deep dive. A country with so much economic potential, good GDP, connected population, but completely tied up in knots by its own unique regulations. Market saturation adding to the pain. And that central, bizarre restriction banning its own citizens from the casinos on their own soil.
And that restriction, that irony,
Yeah.
leads to maybe a final thought for you, the listener, to mull over. The biggest question mark over the future of Bahamian iGaming isn't really about taxes or competition, it's political. Will the Bahamian parliament ever lift that discriminatory ban? Will they let locals gamble in those resorts? Because if they did, that single change would suddenly drop 400,000 potential customers, many with high value, right into the resort's laps. It would completely change the maths. But until then, well, you see the rating. If you want to read the full analysis, the detailed report on the Bahamas, or check out reports in other countries, you can find them all on our website. It's gamblingdatabases.com.
Thank you for joining us on this fascinating, if ultimately frustrating, deep dive into the strange reality of the Bahamian gambling market. We'll catch you on the next one.